Well, earnings season continues with a pessimistic investor outlook born in mixed earnings. But not all sectors are equal, with bright spots to be found past the mega cap FANG stocks. Here with some advice to where investors could look, Brian Vendig, MJP Wealth Advisors President. Thank you for joining me, Brian. So we know that sort of going into earnings season, there was a lot of pessimism about how tough the earnings recession could be. What's your take so far, even though it is still early days in earnings season this quarter?
Good morning, Rachelle. Yeah, I think right now the results still are pretty mixed. I mean, we did have a sigh of relief from some of the earnings reports that came in last week and earlier this week from some of the bigger banks. But at the same point in time, investors are still getting back to the fundamentals and focusing on what companies are saying regarding their margins and their profit outlooks moving forward. And I think we are expecting an earnings decline year over year and probably another earnings decline coming up over the next couple of months, because from a macro perspective, we are seeing more and more signs that the economy is slowing and the consumer cannot continue to prop up the economy as much as we've seen over the last couple of quarters. Now, the other thing that's also weighing on investors' sentiment right now, Rachelle, going into earnings, was we got comments from the Fed that they're looking to, again, increase interest rates as expected, but possibly not cutting rates this year. And I think right now, investors are still expecting rate cuts over the second half of the year, which might be too optimistic. And I think investors are positioning around that. Plus, at the same point in time, things are heating up a little bit on the debt ceiling debate in Washington, and probabilities are increasing, unfortunately, on the side that there might be some issues in politicians reaching an agreement where necessary on the debt ceiling debate. So these are all things that I think are swirling right now, and investors are looking for more information from publicly traded companies over the next week or two to really get comfortable on outlooks and quality of earnings.
And as you mentioned there, I mean, we're going to be getting a Fed decision bang smack in the middle of earnings season there on May 3rd. So with that announcement then, how does that then shape the narrative for the rest of the earnings season and then going into Q2?
Yeah, definitely. I think we're going to expect more of the same with companies talking about balancing cost relative to demand and trying to position price increases where they can, while at the same point in time looking for efficiencies in running their business. Now, as it relates to the Fed and policy decisions that they're making there, I think that really impacts more valuations of making investments moving forward, and investors taking a look at the trade-offs between higher interest rates that they can get on cash and other safe investments, and also taking a look at the fixed income market as compared to stocks. So I think we're in a period of time where the market's probably going to stay in a relative range with some of these fundamental as well as macro factors still needing more time to play out. However, when we look towards the latter part of this year into next year, we do expect the earnings numbers to improve, and we do expect more favorable compares for equities, which really truly are a longer term asset investment.
And you mentioned fixed income. It has been a rather interesting time here for bonds, where we're not really in the set it and forget it mode when it comes to bonds at the moment. So because of the volatility. So a lot of people wondering, have they missed the boat when it comes to bond investing? Is there still value to be found here as we await a Fed pause and a potential pivot at some point?
That's a great question, Rachelle, and I really appreciate that, because right now we think fixed income or bonds are fairly valued. Bonds came off of a tremendously tough year last year, one that we have not seen in many decades, with the average bond market being down around 13%. And I think right now, when you think about inflation, we still believe a good probability of coming down over the balance of this year into next year, and the Fed has said the same, that as interest rates come down, we think overall yield curve over time will eventually flatten, especially because on the short-term side, the Fed might ease back in raising rates this year. And I think it's fair to assume they're not going to do it as aggressively as they did last year. And as a result, as interest rates come down, the prices of bonds go up. So as I said before, looking at different parts of the bond market, both on the short-term side and intermediate side, we find attractive. And I think it's something for investors to consider, because over the last couple of years, people have shied away from bonds. But I think right now there's an opportunity for rates to come down moving forward as the economy slows, and also as inflation comes down as well relative to aggregate demand slowing in the economy.
And then also in terms of portfolio allocation, looking at growth versus value stocks, what are some of the sector standouts for you?
Well, right now on a macro level, we're trying to just keep growth and value stocks at parity or evenly balanced just because of all those things that I mentioned before that are still variables that need some time to play out. But sectors that we like in this environment are the healthcare sector because right now we think they can play offense as well as defense when volatility picks up. A lot of attractive companies looking at innovation. We've seen a pullback in healthcare. It's something to consider as an opportunity, plus pay as a stable dividend. We like the industrial space as well, with globalization, fractured supply chains coming home, people looking for more efficient ways to support e-commerce, as well as you think about the infrastructure spending that's happening. We think industrials still have some room to run over the balance of this year into next year. And then finally, when you think about a slowing economy and where companies are still looking to make investment, we think cybersecurity is a place within the technology sector that you can find some relatively attractive returns over the long run because cyber threats, I think, is now just table stakes as part of running a business, and that type of investment needs to be maintained. While maybe you might be evaluating other spends in technology that might not be as critical as an ongoing basis.